Today we are going to discuss about capital and revenue, and we will try to understand the various aspects of these concepts. Sometimes we do not have very clear conception about this. Many students suffer from a non-clear conception. So this course is actually taken, the small classes taken to clear all your misconceptions about capital revenue expenditure, and make you understand the basics of it and strengthen your base for this particular purpose. So those students who do not know me, this is my this is a short bio of me. So this is I'm a chartered accountant and Masters of Commerce. I'm an accredited financial manager working in the United Nations. Slash to 498 rupees, and this is for a limited time offer. And otherwise, for the other courses, you have always 10% discount offer. If you have if you use this referral code of mine, you are going to get 10% discount. Okay, so with that, let us start today's class, which is called Capital and Revenue Expenditure, and this is the class structure. So we are going to study this, and we are going to understand this capital and revenue. So these are the things which will be covered in this class. One is the types of expenditure, the distinction between different types of expenditure, okay, and your accounting treatment. So these are the three areas which we are going to cover. These are the three areas which we are going to cover. So the class structure is types of expenditure, distinction between different types of expenditure, accounting treatment. Okay. So let us continue over here. So what are the types of expenditure that we come across while we are preparing your accounts? While you prepare your accounts, we come across these three types of expenditure. One is the capital expenditure, one is the revenue expenditure, one is the deferred revenue expenditure. These are the expenditure that we come across in course of our accounts preparation, when we are or when you are actually writing the accounts on a day-to-day basis. We come across these three types of expenditure, and we need to understand what these three types of expenditure are. Okay, so one is called the capital expenditure, one is called the revenue expenditure, and one is called the deferred revenue expenditure. These are the three expenditures. Okay. Capital expenditure is expenditure incurred for any of these. So, basically capital expenditure is basically when you are spending some money to acquire an asset. Okay, it's related to asset. Capital expenditure is expenditure related to asset acquisition, and other related expenses incidental to the asset acquisition or improvement of the capacity. So these are the situations when you consider your expenditure as capital expenditure. If you have incurred the capital expenditure to acquire an asset, okay. If you have made an expenditure which are directly related to the acquiring of the asset, okay. Then next is to improve over an asset. If you made some expenditure to improve its efficiency of the asset, okay, so that is an improvement. Straight away extension of an asset, so you straight away add to the capacity of the asset. To bring the asset to the location of its intended use and to put an asset into working conditions. So these are 1, 2, 3, 4, 5, 6 situations where you actually come across capital expenditure. You incur capital expenditure when, or it will be deemed that you have incurred a capital expenditure when these situations happen, when you are spending money on these situations. So coming back, expenditure incurred to acquire an asset, expenditure which are directly related to the acquiring of an asset, improve over an asset or for the extension of an asset, to bring the asset to the location of its intended use and to put an asset into working condition. So these are the 6 situations where you incur capital expenditure. Okay, so now let us see one by one. One is the acquiring of an asset. So it is basically the basic materials cost of the asset, the price of the asset, the basic price, the main price of the asset. Okay, so it's nothing to be explained over here. I think it's a price of the thing. Okay, it's basically the price. The price. Okay, but only paying for the price of the asset is not enough. Okay, only paying for the price is not asset is always not enough, and there may be other expenditure related to that which will also be capitalized. So when I mean by capitalized, that means I am going to add it to the value of the assets. That is meant by capitalizing. Okay, to capitalize an expenditure means treating that expenditure as an asset. Okay, so it can be a new expenditure altogether. So that means when I am buying a new asset, or I can capitalize the revenue expenditure and add to the value of an asset. Okay, so if my valuation of an asset is 1 lakh rupees, so I can capitalize certain expenditure and add to the value of that asset. So that is in either of these ways. In either of these ways, I can out all these 5 other ways, there can be expenditure and this can be capitalized. Okay, that means the value of an asset will be increased by incurring those expenditure. Okay, so expenditure incurred to buy an asset basically refers to the basic material cost of the asset or the price of the asset. Okay, so as I told you just now. The next one is expenses which are directly related to the acquiring of the asset. So there can be certain expenditure which are directly related to the acquiring of the asset. Okay, so say for example the taxes paid or other government duty like customs duty payable to buy the asset. So if you are buying some assets and there are certain duties to be paid when you buy the asset, some customs duty, if you are importing it, if you have to pay some customs duty, so you have to pay it. So that's form a part of your cost straight away. Okay, that forms a part of the cost of your machines straight away. Okay, and it's huge money. Okay, so your asset value becomes extended to that. Your asset value increases for that. Okay, so for example, if you are buying one asset of say 1 lakh rupees, and for that you have to pay customs duty. You have to pay customs duty to the extent of say 5,000. So this customs duty you are going to capitalize, and your asset value will become 1,05,000. Your asset value will become 1,05,000. So this is what will happen. Okay, this is what is going to happen. So next is, so any legal expenses which you are paying. Okay, say for example you are buying a land, and when you buy a land there are a lot of legal formalities involved. Okay, the lawyers will be required. Okay, you are buying a land or buying a property, buying a factory, you can buy anything. Okay, so like there will be a lot of legal expenses, legal hassles involved, therefore lawyers will be involved. Okay, and there will be some legal expenses like lawyers fees, registration expenses, then there can be stamp duty. Okay, so all these expenses are very much incidental to the buying of that asset. Very much incidental. It's directly related to the acquiring of the asset. If you do not pay, so what I mean by that, if you do not pay these assets, you cannot acquire these assets. If you do not pay these assets, you cannot acquire these assets. If you do not pay for these expenses, you cannot acquire the asset concerned. If you do not pay the lawyer's fees, if the registration expenses is not paid, how can you acquire the asset? It's not possible. If you do not pay the stamp duty, it will not happen. It is not going to be, you cannot buy the goods, actually buy the asset that you are intending to buy. So these are compulsory expenses. But since these are expenses related to the particular asset, related to the acquiring of that particular asset, you must add these expenses to the value of that asset. That is, you should capitalize. So I'm telling you again, to capitalize means to treat an expenditure as an asset. Okay, and therefore add it to the value of the asset for which it is incurred. That is the capitalizing. Okay, so this is the first case. The second case is that improving over an asset. Okay, so expenditure that improves the efficiency of an asset. Okay, you can sometimes make certain alterations and alterations to the machineries, and you can increase your production. Okay, so one of the particular part that the machine works with can be altered, can be exchanged. Okay, you are not replacing the whole machine. Maybe one part of the machine, one particular important part of the machine, which is say for example got rusted or it's not working properly, so you just come and replace it. Okay, you can replace it or make certain improvements on that. Okay, you clean it, or you make some certain small repairs, or you make certain other designing alterations. Okay, you can employ somebody and make some designing alterations in the particular spare of the machine concerned, in the particular part of the machine concerned, and after you do that, the machinery starts performing very, very well, and the production is augmented. So your production increases. So if you are making any expenditure like this is again a capital expenditure. And this has to be capitalized. Okay. Next here is extension of an asset. So this is directly expenditure incurred directly to increase the capacity of an asset. So if you go to one furnace, you add one more furnace. Okay. If you go to one factory building, you add one more factory building. If you go to one factory building, you build a few more houses, or build a few more rooms. Okay. If you have got a guest house, okay, the company has a guest house, if the company builds or adds more houses to that house, so it's an extension. So it's an extension. So you already have something more physical. Okay. Something more is physically added. Something more physically added. Something more is physically added. Okay, and then some the value of the asset increases. Okay, and of course the capacity will increase. Okay, so that is again another type of capital expenditure that happens. Okay, the next one is expenses incurred to bring the assets to its intended location. So now your asset has come, your machine has come now from it's somewhere in the docks. Okay, so from there you have to bring it to your factory, which is not near the docks. So you have to spend some carriage charges, isn't it? Some carriage charges have to be paid, some labor charges have to be paid. Okay, in order to lift the machine from the ship to your truck, or from your truck to your particular premises. All these things are there. So all this expenditure that you are incurring to you're doing is to bring the asset to its intended location. That is what you want to doing. That is basically what you are doing. You are bringing the asset to its intended location, and all the expenditure that you are incurring on this will be considered as capital expenditure. Will be considered as capital expenditure. Then putting an asset into working condition. So now you have brought the machine. It is there. Okay, you paid the customs duty first of all. Okay, then you got the legal paper for the asset. Okay, and then you put it in the truck, and then engage certain coolies to put it in the truck. It came to your premises again. Some more workmen to to get the machine placed from those trucks to the particular place where you intend to plant the machine, to keep the machine. But that is not enough. That is not enough. There can be certain other requirements also. You might have to actually implant the machine into the well, into the ground. Okay, so for that there will be some erection charges. Okay, and these are called erection charges. These are installation expenses. These are all technical expenses. These are all technical type of expenses, and which are must to ensure that the asset is actually installed properly. If the asset is not installed properly, the asset is not going to work. And maybe sometimes you might have to pay even consultancy charges. You might have to pay consultancy charges. You might have to pay consultancy charges to actually install these machines. There can be some specialist consultants who know about the machine, how to put it. You have to fix the wires properly, fix the jacks properly, the plugging has to be done nicely, correctly. Okay, and the positive negative power connections has to be done properly. Okay, so and you might not be so much aware of it. So as a owner, you might not be aware. Okay, so you might require some engineers or some certain other persons or external persons who understands these machines well, and for that, in order to install or erect this machinery at your premises, okay, they are going to charge you. They are going to charge you. So that is called consultancy charges, and these are also capitalized. These are also capitalized, because if you do not pay that particular expenses, you cannot start running the machine. Simple. So these are expenses which are incidental, or which are basically required to put an asset to its working condition. If you want to put the asset to its working condition, this is the thing that you have to, these are the expenses that you have to incur. Okay. Then there are again certain other, okay, so these are the 6. So what have you seen? Let us see. What have we seen? We have seen that expenditure to acquire an asset. So this is basically the material cost of it. Okay, these are, then we have got the expenditure which are directly related to acquiring the asset. So you have to pay customs duty, you have to pay stamp duty, you have to pay legal charges, you have to pay other expenses. Okay, so in order to get possession of the asset, in order to buy the asset, to get possession of the asset, to get legal ownership of the asset, you have to incur all these expenses. Okay, so these are the expenses. Next is to improve over an asset. Okay, so to improve over an asset means you make certain alterations in the asset, and capacity of the asset improves by leaps and bounds, and it does starts performing really very well. Okay, so these type of expenditure. So all the expenditure that you incur to make that certain alteration or certain change in your machine spare parts or machine positioning or machine functioning in some manner or other. So if you improve that on it, and if you have to incur certain expenditure for that, that is also capitalized. Okay. Then there is a extension of an asset. You straight away extend your asset. So you build 2 more houses, three or 4 more rooms in your guest house. So there's an extension of an asset. Okay, so if you are having one plant which is having a capacity of 2 or more, having a capacity of say 500 units production. So you add to it and make it 750 or say another 500 more. So this is a direct extension, is nothing but acquiring only. Okay. And when you are actually acquiring, when you are extending, or that means when you are acquiring another part of that, not another part, you are just adding it to it. Okay, so when you are doing that, if you are making any expenses for this directly related to the acquiring of the asset, you have to capitalize that also. Then you have to okay, so you have to bring the asset. You might have to spend some money to bring the asset to the location of its intended use, where you want to bring the asset. So it's talking about carriage inwards, we're talking about labor charges to lift the asset and bring it to the particular location where factory is. Okay, then to put that asset into working condition, so you might have to pay some erection charges, some installation charges, some consultancy charges. Okay, some labor charges to do the erection work as such. To erect the machine, to install the machine by itself is something. So it's quite important. Okay, and without that, if you cannot erect or if you cannot install a machine, all the expenditure that you have incurred will be of no use, will be of no use, because you cannot use the machine. So all these expenditure that are there are equally important. There is no expenditure which is less important over here, and all this expenditure will be treated as capital expenditure. That means it will be added to the value of the asset. Okay, that is basically what capital expenditure means. Either it's an expenditure on an asset, or it is an expenditure on asset, incurred to buy an asset, or expenditure incurred in relation to an asset which will increase the value of the asset in some way or other, or which will put the asset into its working condition, which will improve over an asset, which will extend the capacity of an asset, which will bring the asset to its location. So all these expenditure that you incur are called capital expenditure. Okay. Now we come to revenue expenditure. Now remember, all the expenditure that you have talked over here, from here, except for here. Okay, all these expenditure, except for an extension, normally all the expenditure that you have incurred are primarily revenue expenditure. Revenue expenditure means expenditure incurred only to buy an this is okay. So I will now take to the revenue expenses. Expenditure incurred for running the business, expenditure incurred to maintain the assets. Okay, these are the types of expenditure that you have for revenue expenses. So the day-to-day expenditure that you incur, not only the day-to-day but also the direct expenses. So first is your operating expenses of the business, the expenses that you require to make, just basic expenses. Okay, so the materials cost. So you buy the materials. If you want to manufacture something, you need to buy the materials. Okay, then you've got a manufacturing overhead. Okay, manufacturing the overhead. So materials, and then you also have got the labor. Then you have certain direct expenses also. Okay, then you have manufacturing overhead and administrative overhead. Then you also have some other expenses like financial cost or selling expenses, and also we have the non-cash expenses, which is depreciation. So this is the revenue expenses. The effect of revenue expenses is actually not lasting. It expires within the accounting year when it is incurred. Okay, the effect of a revenue expenditure is not lasting. The benefit that you get out of a revenue expenditure is actually does not last for more than a year when you are incurred. Okay, so that is why it is charged off in the particular year, of expenditure. But capital expenditure are long lasting. If you buy an asset, it is going to give you benefit for the next 10 years. If you buy a machine, it is going to produce goods or give you production for the next 10 years. So the effects of the expenditure are long lasting, but effects of revenue expenditure are not long lasting. The effects of it, or the benefits out of the expenditure, are exhausted within the particular year concerned. Okay, so that is why they are called revenue expenditure, and these are called capital expenditure. So this is, you must remember this long lasting effects of the expenditure. Effects in terms means what benefits you are going to get out of this expenditure incurred. We know capital expenditure, the benefits that you are going to get are actually spread over a period of years. But for revenue expenditure, this is not the case. Okay, it is not the case. It expires, the effect of it expires within the particular year. Okay, so this is the thing. And these are the types of revenue expenditure that you have got. Okay, operating expenses, the expenses that you require to run your business, or basically production, your direct costs, basically the expenses that you need to make your primary business. If you do not incur all these things, you cannot manufacture and sell. Simple. Okay. Then finally, you also have other expenses like financial cost or selling expenses. Okay, and then these are the expenses which are a part of which are revenue expenditure. And you also have certain non-cash expenses like depreciation. It's a revenue expenditure is basically the cost of the asset that you are writing it off over a period of in the particular year. The assets cost are written off over a period of years, and each year what you charge off to the accounts is called depreciation. Okay, so this is that. As I told you, expenditure effect of capital and revenue expenditure. Revenue expenditure effects are not long lasting. Capital expenditure effects are. Okay, I told you. There is certain other expenditure called deferred revenue expenditure. Deferred revenue expenditure are those expenditure, the effects and benefits of which are extended over the accounting year when it is incurred. Okay, involves huge volume of expenditure incurred in 1 year. But basically, you must understand that these are revenue expenditure only. Okay, these are revenue expenditure only. In normal course, this would have been treated as a revenue expenditure. For example, advertisement. Now, if you made some hoardings and gave some advertisement or made certain pamphlets, okay, and you incurred say 30,000 rupees for all that. So this is a revenue expenditure, and you charge it off to your accounts. You are going debit profit and loss account, credit advertisement account, finished. But if this 30,000 figure is not the figure, not this figure, if the advertisement figure is not this figure, you have hired a solid advertisement consultant, and they have done a tremendous propaganda, and they took all sorts of marketing efforts, and you have spent 3 crores minimum. So do you think it is fair to write off this amount in the profit and loss account? It is not, because the effect of this 3 crores of advertisement is going to last long. Okay, it's going to last long. It is not going to be over in that particular period. So these expenditure, which are basically revenue type, but the effects of which, the benefits of which are to arise over the period of the years, okay, whose benefits is extended beyond the accounting year when it is spent, are called deferred revenue expenditure. Defer, you are deferring it. Okay, you are going to defer it. You are not going to charge it off immediately. You are going to defer the charge. Deferred revenue means you are going to defer, you slow it. Okay, you procrastinate it, you postpone it. Okay, deferring means postpone. So you are going to postpone the charging. Okay, you are not going to charge it off fully. You are going to slowly charge it. You are going to charge it over a period of years. The benefit is expected to be given out of such expenditure. Okay, over the number of years, the benefit is expected to take place, or benefit is expected to be received by the business over a period of years. So that is why it is called deferred revenue expenditure. It is deferred, and each year we are going to write off a certain part of that in the profit loss account. Okay, that depends on the accounting policy. Okay, so accounting treatment, capital expenditure or balance sheet items, there is nothing as such. Capital expenditure entails depreciation. Yes, if you have capital expenditure, you must also have expenditure. The cost involved, the depreciation charge, the accumulated depreciation, the net value of the assets created out of capital expenditure will be disclosed. Okay, so in your accounts, you have to disclose what is the cost involved, what is the depreciation charge. Okay, so that will be the profit loss item. What is the accumulated depreciation as on date. Okay, and the net value of the assets created out of expenditure will be disclosed. Revenue expenditure or profit loss account. Okay, these are profit loss account items. So you have to include it in your profit loss account to determine your profit or loss. To determine your profit or loss, you need to know your expenditure. Simple. Okay, and then deferred revenue expenditure are simultaneously revenue and capital items. Why? Why? Because a certain part of the deferred revenue expenditure are written off over a period of years as per the accounting policy. Okay, such charge off will be reflected in the profit loss account, and the unamortized part of the deferred revenue expenditure will be disclosed in the balance sheet. So that is how it is going to happen. Okay, charge off will be reflected in the profit loss account, and the unamortized part of the deferred revenue will be disclosed in the balance sheet. So I will tell you like how. So say for instance, your say for example, you have spent on advertisement, a huge advertisement campaign your company did, and this was the expenditure that you incurred. You incur an expenditure of say 1 crore. Okay. Now, according to the marketing team, the marketing team feels that the effect of this 1 crore of advertisement is going to last for at least 4 years. Okay, at least 4 years. So each year your profit and loss account will be debited by 25 lakhs. So profit and loss account debit. So your first entry is like advertisement debit, bank credit to bank, advertisement account debit to bank. First of all, sorry. Okay, so this is your 100 lakhs. Okay. So according to the marketing team, the effect of this is going to be 4 years. So in this year, you are going to debit profit loss account. Profit loss account will be debited to the extent of 25, and advertisement will be credited to the extent of 25 also. Okay, so this balance of advertisement account, so in your balance sheet, asset side, this advertisement which is not yet amortized, which is not yet written off, will come as deferred revenue expenditure. Deferred revenue expenditure. So you have to write the header deferred revenue expenditure like this. So, and you will write advertisement expenses yet to be amortized, and the figure will be 75 lakhs. So that is the treatment that you have. Next year you are going to write off another 25. So your figure will become, next year it will become 25. Okay. Then the third year you are going to, no, this will become 50. Then the third year you are going to charge another 25, so it will become 25. And the last year when you charge of the whole thing, it will become 0. So this is how it will happen. And in your charge, every year the charge will be the same figure. Charge in PL will be PL account, will be straight away this one 25, 25, 25, 25. So this will happen. So this is the treatment of capital and revenue expenditure. So with this I should end this class. There is nothing much more to discuss on this. So I hope you have understood this session, and you can take up, there can be various type of questions. They will give you examples basically. So always remember this concept. If you remember this, nobody can ever try to fool you on this capital expenditure. Just remember this, that these are the areas, these are the avenues of capital expenditure getting incurred. Apart from this, there are no other avenues where capital expenditure can get incurred. So you see under which particular category the question or the transaction that is given in the question falls. If it does not fall in any of this, then it will be a revenue expenditure, or it can be a deferred revenue expenditure also. So it's, at least it will not be a capital expenditure. So you will know that. Okay then, so with that students, let me end this session, and thank you very much, and I wish you all of you great exams and success in your examinations. So go ahead, have a flying color, come out with flying colors. See you.